This is a Brooklyn-bound 2 train. The next stop is Wall Street.
Stand clear of the closing doors, please.
Hey, happy holidays. This is not your advisor with NYU grad. With the holidays, I wanted to take the time and reshare this important lesson. I wish you all a happy holidays wherever you are in the world. It's been an unbelievable year. I look forward to 2025 and creating more content, sharing more knowledge, and learning from each other. So to you and your family, stay safe, have a happy holidays, enjoy each other, and enjoy this replay. Keep in mind, this was AI generated with cited sources from the material that I shared previously. I'll see you all soon.
Welcome to today's deep dive. You know we love getting into the nitty-gritty of the financial world. And today we've got some great material to work with. We're going to be taking a look at some analysis from financial expert Bill Cara. You sent over 3 of his recent articles, and it's fascinating stuff.
Yeah, they really are. His work is always thought-provoking, and I think what's really interesting here is how Cara connects the dots between rising U.S. debt and what that might mean for the stock market, especially in these 2 most recent pieces.
Exactly. So the first article, The Imminent Threat of a Market Crash, from December 4th, kind of laid some groundwork, but we're really going to focus on the 2 he published later in the month. Understanding the market forces at play, from the 19th, and how the growing U.S. debt is squeezing out equity investment, which just came out on the 23rd. I think for anyone trying to make sense of the current economic climate, and maybe, especially as we're all thinking ahead to the new year, this is a conversation you do not want to miss.
Absolutely. By the end of this deep dive, you'll have a much clearer picture of these complex issues and how they could affect your own financial decisions.
So let's jump right in. Cara's latest article, How the Growing U.S. Debt is Squeezing Out Equity Investment, really caught my eye. He makes this compelling argument about the link between U.S. Treasury yields and what happens to stock prices. Can you break that down for us a bit?
Absolutely. It's a connection that often flies under the radar. So basically, when the U.S. government needs to borrow more money to cover its debts, it issues treasury bonds. And to make these bonds attractive to investors, they got to offer a higher interest rate, right? What's called a treasury yield.
The more debt the government has, the higher those yields go.
Exactly. And that's where things get interesting, because those rising treasury yields start to look more and more appealing compared to investing in the stock market.
I see, because they're seen as a safer investment with a more guaranteed return.
Exactly. Investors start shifting their money out of stocks and into those safer, higher-yielding treasury bonds. And as that happens, as that money moves, it can lead to a decline in stock prices.
Almost like a seesaw effect.
Yeah.
As treasury yields go up, stock prices go down.
Exactly. Cara even includes this helpful chart in the article that visually demonstrates this inverse relationship using the New York Stock Exchange Index and the 10-year treasury yield.
Visuals like that are always helpful. So how does this all connect back to the possibility of a market crash?
Well, in his earlier article, The Imminent Threat of a Market Crash, Cara points to a number of factors that he believes are contributing to this kind of underlying market instability. Things like unsustainable market performance, where the gains just don't match up with the economic reality, and high levels of insider selling, where, those with inside knowledge of companies are getting out while the getting is good.
Those definitely sound like red flags.
They certainly are. And what's interesting is how he connects these warnings from that December 4th article to his later analysis of rising U.S. debt in How the Growing U.S. Debt is Squeezing Out Equity Investment. He's arguing that increasing national debt, along with other economic policies, could be a driving force behind those very red flags he identified earlier. All these things are feeding into each other.
That makes a lot of sense. And he's not afraid to kind of, name names when it comes to the impact of economic policy, is he?
He certainly isn't. He even brings up Elon Musk's criticism of the Federal Reserve, particularly Musk's claim that the Fed is grossly overstaffed. But Cara uses this to kind of clarify the Fed's role, emphasizing that it's not a government agency that's directly controlled by the president, as some people might believe.
Right. It's important to understand that distinction to push back against this idea that, the president has direct control over things like interest rates.
Exactly. And that clarification kind of paves the way for his deeper dive into the forces at play in the market, which he really gets into in understanding the market forces at play.
Okay, so let's move on to that article then. One thing that really struck me was Cara's frustration with what he calls superficial responses to market news. He seems to think that this focus on things like Fed announcements and earnings reports is kind of distracting us from the bigger picture.
He does, and he argues that those distractions allow a select group, what he calls humongous banks and brokers, or HB&Bs, for short, to manipulate the market in ways that benefit them, often at the expense of everyday investors.
He's suggesting they have that much power.
That's exactly what he's saying. And he explains how, in this article, he believes that these HB&Bs use these complex algorithms, which he refers to as BOTS, to control market prices.
So he actually gives an example of someone he calls Basket Guy, who observed these BOTS probing the market right before a major sell-off. That's a pretty unsettling image, isn't it?
It certainly is. And it really gets at the heart of Cara's argument here. These HB&Bs are exploiting basic human emotions like fear and greed to drive the market in their favor. They create these bull markets driving prices up, and then they sell when it's most profitable for them, often leaving everyday investors holding the bag when the market inevitably corrects. It's a pattern he points to repeatedly.
It sounds incredibly manipulative. He even goes so far as to criticize the Securities Acts of 1933 and 1934, arguing that they actually allow these HB&Bs to operate on both sides of trades.
His point is that this creates a system where these institutions can prioritize their own profits over their clients' interests. He uses this really powerful analogy to drive this point home, comparing financial transactions to a legal proceeding where all the lawyers and the judge are partners in the same firm.
Wow, that's a disturbing thought. It suggests the system is inherently biased against the average investor.
Exactly. And that makes his prediction of an imminent market crash all the more concerning. He sees a situation where the public is likely to suffer significant losses while these HB&Bs protect themselves.
Right, and it connects back to his earlier article, The Imminent Threat of a Market Crash, where he highlighted warning signs like unsustainable market performance and high levels of insider selling. And even in that first article, he uses that memorable anecdote about an advertising CEO to illustrate his point.
You're talking about the CEO who said his clients would often increase their promotional spending right before going bankrupt.
Yes, it's like this desperate attempt to save themselves, even though the writing's already on the wall.
And Cara uses that story to illustrate how human psychology plays into market behavior, particularly the dangers of clinging to hope even when you're faced with overwhelming evidence to the contrary. He sees these same patterns playing out in the current market, fueled by what he perceives as just this dangerous level of optimism.
That's a sobering thought. And it seems like his biggest concern is that these HB&Bs are set to benefit, while the public bears the brunt of the consequences.
Absolutely. That's why he's calling for people to think critically and to recognize that these HB&Bs are not their allies but potential adversaries. He's urging us to wake up to the reality of the system and make informed decisions based on that awareness.
It's a call for vigilance for awareness.
Absolutely. And a reminder that we're not powerless in the face of these forces. We can educate ourselves, make strategic choices, and advocate for a more transparent and equitable financial system.
It's a powerful message and one that we'll definitely need to unpack further.
I agree. And I think the best place to start is by looking more closely at those warning signs he identified in the imminent threat of a market crash. He lays out some very specific indicators that support his concerns.
That sounds like a great place to pick up after a quick break. When we come back, we'll explore those indicators in detail and discuss what they might mean for you and your own financial decisions.
So diving back into Cara's December 4th article, The Imminent Threat of a Market Crash, he starts by taking a look at the performance of some of those, those major market indices like the S&P 500 and the NASDAQ 100.
And he doesn't seem too impressed with what he's seeing, right?
Not really, no. He presents data showing significant gains in these indices over various time frames, but his argument is that those gains are unsustainable. They're detached from the real economic fundamentals.
Like a house of cards built on shaky ground.
Exactly. And to support this point, he highlights the high levels of insider selling that are happening while all of this is going on. Basically, people with inside knowledge of these companies are selling off their stock, and that's usually not a good sign.
It makes you wonder, what do they know that we don't?
Right. It suggests a lack of confidence in the continued upward trajectory of the market, even as everyday investors are being told to buy in.
He also brings up the rising number of corporate bankruptcies, too.
He does, and he connects this back to that anecdote we were discussing earlier about the advertising CEO whose clients would increase their spending right before going under. It's a pattern he sees repeating itself on a larger scale, with companies struggling to stay afloat even as the market appears to be booming. He even uses a visual from Visual Capitalist to show just how many businesses have failed in recent years, and it's a pretty stark picture.
So we're seeing a lot of these warning signs flashing red, even before we consider the potential impact of rising U.S. debt and market manipulation.
Exactly. And then, to really drive home the point, he brings up the legendary investor Peter Lynch. Apparently, Lynch recently outlined a series of market top indicators in a social media post, and according to Cara, all 13 of those indicators are currently pointing towards a market peak.
13 out of 13. That's a pretty clear signal, especially coming from someone like Peter Lynch.
It certainly is. And then he reminds us of Warren Buffett's famous advice to be fearful when others are greedy and greedy when others are fearful. He points to CNN's Fear and Greed Index, which at the time of his writing was showing greed.
So according to Cara, the current market sentiment is completely out of sync with the underlying reality.
Exactly. He believes this widespread optimism is actually a sign that trouble is brewing and that the market is ripe for a correction. He even goes so far as to predict a market pullback starting in January, possibly triggered by JP Morgan Chase's upcoming earnings report.
So he's not just talking about a potential crash in some abstract future, he's actually putting a timeline on it.
He is, and that makes his warnings all the more urgent. He even points to the Federal Reserve's recent decision to cut policy rates as a sign that they're trying to prop up a system that's already teetering on the edge.
It's like they're trying to paper over the cracks instead of addressing the underlying structural problems.
That's a great analogy. And then he drops another bombshell. He talks about Warren Buffett's recent investment moves. Specifically, he highlights the fact that Buffett has accumulated a record amount of cash, over $325 billion.
So even the Oracle of Omaha is seeing the writing on the wall.
It certainly seems that way. And to add to that, Cara mentions that Buffett has been selling off some of his Apple stock, which is significant considering that Apple has been one of his largest holdings for years.
That definitely sends a strong signal, especially given Buffett's reputation for long-term investing.
Right. It suggests that even someone with his long-term perspective is sensing a shift in the market, a need to be more cautious. And it all circles back to Cara's earlier points about unsustainable market gains and the potential risks associated with rising U.S. debt.
It's like all of these seemingly disparate pieces of information are coming together to form a very clear and very concerning picture.
Exactly. And it underscores the importance of Cara's core message. We need to think critically about the information we're being given and question the assumptions we've made about how the financial system works. We need to recognize the potential for manipulation and make informed decisions that protect our own interests.
It's a call for vigilance, for awareness.
Absolutely. And it's a reminder that we're not powerless in the face of these forces. We can educate ourselves, make strategic choices, and advocate for a more transparent and equitable financial system.
And Cara doesn't leave us hanging with just warnings. He also offers some valuable advice in his articles, especially in understanding the market forces at play, about how to navigate these treacherous waters.
I agree, and I think that's where we should focus our attention next. Let's delve into Cara's recommendations for how everyday investors can protect themselves in a market that might be rigged against them.
That sounds like a great plan. Let's dive in. Okay, so we spent a lot of time unpacking Bill Cara's analysis of the market and the warning signs he sees pointing towards a potential crash. But it's not all doom and gloom. Amidst all these warnings, he also offers some really valuable advice for how to navigate these turbulent waters, especially in his December 19th article, Understanding the Market Forces at Play.
Right. It's like he's saying, okay, I've shown you the potential dangers now. Let's talk about how to protect yourself.
Exactly. So what are some of the key strategies that Cara recommends for everyday investors?
Well, I think first and foremost, he really emphasizes the importance of critical thinking. He wants us to question the information we're being fed, especially by those he calls the humongous banks and brokers, or HBMBs. Don't just take headlines at face value or blindly follow market trends.
He really wants us to become more discerning consumers of financial information.
Exactly. He encourages us to dig deeper, explore alternative perspectives, and even challenge our own assumptions. Don't be afraid to ask tough questions and seek out sources you trust.
He also reminds us that these HBNBs, despite their powerful positions, aren't infallible.
That's right. He points out that their algorithms, the BOTS he talks about, are designed to react to market data, which means they can be susceptible to unexpected events or shifts in sentiment.
So even these sophisticated systems can be caught off guard.
Precisely. And that creates opportunities for savvy investors who are able to see through the noise and anticipate those unexpected turns.
So knowledge and awareness really are our most powerful tools in this environment.
Absolutely. Cara encourages us to learn as much as we can about the forces driving the market, the players involved, and the strategies they employ. The more we understand, the better equipped we'll be to make informed decisions.
And it's not just about protecting ourselves from potential losses, right?
Yeah.
He also talks about how we can use this knowledge to actually identify opportunities.
That's a great point. He reminds us that market corrections, even significant ones, often create opportunities for those who are prepared. When prices drop, it can be a chance to buy undervalued assets or to shift your investments into areas that are less susceptible to the whims of the market.
It's like the old saying, buy low, sell high.
Exactly.
Yeah.
But the key is to be ready for those opportunities when they arise, and that requires a combination of knowledge preparation and a willingness to act decisively.
He also reminds us that we're not alone in this. There are resources available, experts we can turn to, and communities of like-minded investors who are also seeking to navigate these complex waters.
Right, and he encourages us to seek out those resources. He even plugs his own website, BillCara.com, as a place to find more in-depth analysis and insights.
And of course, we want to remind everyone that this deep dive was brought to you by NotYourAdvisor.com and NYU Grad, where you can find even more resources to help you on your financial journey.
Exactly. And as we wrap up this deep dive into Bill Cara's analysis, I think it's important to emphasize that this is just one perspective, albeit a well-informed and thought-provoking one. We encourage you to do your own research, explore other viewpoints, and ultimately make the decisions that are right for you.
It's been a fascinating exploration of some complex and, let's be honest, a little bit frightening aspects of the financial market. But as we head into the holiday season, it's also a reminder to approach our financial decisions with a sense of awareness, a healthy dose of skepticism, and a commitment to protecting our own interests.
And on that note, we want to wish you a very happy holiday season.
May your portfolio be merry and bright.
And remember, knowledge is power. The more you learn about the forces shaping the financial landscape, the better equipped you'll be to weather any storm.
Thank you for joining us for this deep dive. We hope you found it informative and empowering.
That's my train.
Stand clear of the closing doors, please.